Hi there, it's Bill with Smart Trades, and it's Wednesday, 7/7/2010. It's about lunchtime back east, 9:20 here on the West Coast. And gonna take a look at the S&P today and take a look at some of the daily and weekly patterns for the most part. And one count that I have yet to see, and it's interesting to me that no one has posted anything quite like this, because to me it's the most obvious count, is that off the April high we have a series of ABCs evolving here. Um, Obviously A, B, C, X, and then what I believe is another A. We're working on another B, and then we should have one more leg down to complete a double zigzag pattern. Now, just a note on the way that I play a little bit fast and loose with Elliott wave labels. Sometimes for example, I had labeled this A down and then B back up. As a practical matter, it really doesn't matter whether you label this as a zigzag, double zigzag, or whatever. The essence of Elliott wave, at least to my way of thinking, is that we're looking for two similar magnitude declines. In other words, A, B, C, or if you want to label them A, B, C, X, A, B, C. 6 of one, half a dozen of the other. As we get into the termination of a pattern, you want to look at the shorter term patterns and see if they're confirming your work, and I think that's very important. But at this point, really what we're looking at is the broad picture here. We're trying to determine, what are the relationships of the declines, and what is the decline? Is it an impulse, the beginning of a bear market, or is it corrective? I think the evidence is that the decline is an evolving correction, and that it's probably got some more to go. It's possible it's finished. I tend to doubt that. Actually, so far it has actually held very close to a previous fourth wave low, which comes in around the 1029, 1030 level on a closing basis. We've dipped below there, but as you can see, we've found support on each of those dips so far. That said, support is broken frequently, so let's watch it and see again how it evolves. Anyway, let's look at the relationship of these declines. I think this is probably one of the most important things here. And one of the nice things about TradeStation, it allows you to actually measure the time of a trend line, and just by connecting 2 points. In this case, A is about 8 days long, 8 trading days. Now, interestingly, C, as I've labeled here, is also 8 trading days long. Lo and behold, the second A in our double zigzag is 8 or 9 trading days long, depending on exactly how you're measuring it. So it stands to reason we may have one more approximate 8-day decline to complete this pattern, if indeed it's a double zigzag. X is, the retracement is of a similar magnitude. So, if you will, we have a family of fractals breaking off the high, all related in terms of a relative price and relative time. As you can see, A down and C down are similar magnitude and price, as is the second A. I think it's important that sometimes you just, if it walks and quacks like a duck, maybe it is a duck. And in this case, we've got very similar magnitude declines. That indicates to me they're related, so to speak. And if these are all related, these declines best count as a series of ABCs, or corrective declines, which again, we've got one more to complete the pattern. It could also turn into a triple zigzag, but we'll cross that bridge when we get to it. Okay, I'm going to scroll back a bit in time, and we're going to look at the bigger picture. Pardon the mess here with my labels, but if you look at, here is my longer term label, that this rally is either 1 up, or what I prefer is that this is whether it's a triple zigzag up or whether it's 5 up, that you label it as A. If you label that as A, then we've got a decline that's coming down is going to be a B wave, obviously, and then we should go back up again. 50% of this entire rally comes in around this 945, 950 area. This area is also interesting because this is an area of previous resistance for the market, both on the way up and on the way down. You've got highs around that 936 area and then around 949, so let's make that 950. So at any rate, that 940, 950 area should be support just based on a non-Elliott wave previous support resistance type swing analysis of the weekly and daily charts. So 950 becomes an interesting point, and again a 50% retracement, not necessarily a Fibbo, but nonetheless oftentimes markets retrace about 50% in a correction, as Gann noted many years ago. Also, here's our previous fourth wave support, again so far holding. And one more thing I'd like to look at here before we go. If you take two equal legs down, in other words our first ABC, and you measure it from X, that also comes in approximately around that 950 area. So you'll have your first ABC approximately equal to your second ABC around 950. Doesn't guarantee we're going to get there, but it's more support that 950 area is important. And let's scroll out just a bit here. If we were to take, assume this market's going to rally a bit off of our recent lows, perhaps back into this 975 area where we have a gap. We also have a small congestion on the hourly charts. That will have two equal legs down. In other words, A will equal C at approximately the 950, 956 area. Again, we're getting ahead of ourselves a bit, but let's just assume that the bounce is coming into this 1070, 1080 area. Again, that allows for two equal legs down, which would terminate also again around 950. So more evidence again that 950 may be an important point to look for. And finally, let's do a little bit of trend line analysis, and let's connect the recent swing highs. We're assuming again that this is a correction. Let's take a parallel trend channel, and let's we've got bad data down here, obviously, so this may be too far extended. However, let's connect with the actual closing lows, and you can see we've got a nice hit here on that parallel channel. Let's go to the closing low off of C. Again, that's even a little better. Let's spin out a bit again, and you'll see that if you extend the parallel trend channel and we were to go up and come back down, we're going to hit that channel somewhere above the 950 level, perhaps 970. As you well know, we may have throw over, and let's just pull that down off the lows, and there you go. There's our target area of 950 and a parallel channel to meet the market when it gets there. Now, as always, we'll take it one step at a time. What we want to do, both when we get up, if we get up to around the 1070 area, is see if the short-term price patterns fit with our longer-term analysis, and likewise, if we do get a decline, it's down to around the 950 area in the C wave position, it should either be a zigzag type termination or a 5-wave pattern terminating into that 940, 950, 960 area, somewhere in there. But we'll have to see how it goes. But to my way of thinking, again, the more I look at this, the more this whole decline does look corrective. You've got two equal legs down, both in price and time approximately. You have an ensuing correction that is of appropriate magnitude, and now you're working on a second pair of legs to the downside, also at least so far of similar magnitude. So that's my count, and we'll see how it works out. But for now, we're probably looking up a bit, perhaps to the 1075 area, but we'll take that one step at a time. Breadth is good. The market is holding and seems to be in an impulse pattern. We could certainly drop back down to test the 1,000 level on the S&P one more time, and it wouldn't ruin the count. But as of now, you've got nearly perfect magnitude declines, both in price and time, down to this low at A. So we'll see what happens. Thanks for watching. Bye-bye.